Hello, welcome back. Let's talk about another semiconductor company which is actually trending right now. Its own Semiconductor Corporation has 30,000 employees, actually pretty large company and a very high beta, meaning that it's more volatile than the overall market, 70% more it looks like based on what we're seeing here. Now, I do like the industry. I do like semiconductors. Now, currently, at this current environment, inflationary environment, it can be a little bit more expensive for these kinds of companies to get their own materials and stuff. But generally speaking, I am a fan of this kind of industry, the semiconductor industry, and this is why whenever there is a trending company and whenever there are some interesting news about semiconductors, I tend to like making videos about it and talk a little bit about these companies. I feel that they can be interesting additions to a portfolio. Although remember that it's a very competitive industry. But if we're getting a company at a good price, then we can hold it for a few years and expect to get some nice return if they're doing well, of course. Now you will see this one has been down 22% from its recent highs, and if we take it to the max, you will see that it used to be a company of $24 trading at $24, and it has reached the max of 71 it was here, and it's down again about 20% from its recent highs. So the thing is, and what I typically don't really like to see for this kind of charts here, if I'm based on the chart, I don't like to see companies that are trading that much higher, and it hasn't happened for a long time, so they haven't really have a base action around these levels. Because when they reach that high, they can go down quite quickly as well. And that doesn't mean that they won't be able to go back again. But I generally speaking like to buy stocks at lower prices. Now, a low price is not about the chart. The chart is about trading, so this can have some merit for traders. But a low price is about the fundamentals, which we're going to be examining next. 24.4 in terms of a P ratio here, which is a little bit more than we would like out of a company of that sort. I would like to get it at these levels, of course. That would be awesome, not terrible, that would be awesome. 18% for its price to free cash flow ratio is pretty good over here. We will examine that in detail. Outstanding shares, a little bit of an extra issuing here, issuance of shares. That's fine with me, 3% is not significant in 5 years. And a 3.89 free cash flow to total liabilities ratio, which means that they made enough free cash flow last year to pay their total liabilities in almost 4 years if they were using this free cash flow. So 4 times as much to pay all the total liabilities. That's pretty good. 5-year total revenue growth has been increasing. A few years before it was actually down and trading at a range for the most part. Net income growth, about the same story here pretty much. And yeah, this is something that I typically like to see for companies. The fact that these charts are very similar, you see, at the way they are charted here. This is why I love looking at these charts as well. Because you can see that the company's net income seems to be aligning with her free cash flow and all that. And so that's, generally speaking, a good thing to expect and see from a company. 5-year total equity growth has also been increasing. Debt to equity ratio is marginally red here because we typically want to be getting it at less than 1, but I'm not really concerned about this one. Good gross profit margins, okay, net income margins here, and return on equity of 25%, that's pretty good. And return on invested capital of 16%. All right, let's take a closer look now. I want to see what the company has been doing throughout the years. 5.5 billion to 6.74 billion. You will see that it hasn't grown that much. Again, we kind of saw that in the revenue growth, 5-year revenue growth. And what about the net income? 800 million to 1 billion. Yeah, that's not significant growth, of course, as you'll see. Although it has risen a lot from 2020. That can be a little bit concerning. I don't know if this is sustainable, actually. Though the balance sheet of the company, if we take a look at it here, you will see total assets of 9.6 billion, total liabilities of 5.022 billion. And remember that we saw a free cash flow of last year to total liabilities ratio of like almost 4. So we're expecting the free cash flow of last year to have been about 1.2 billion or something of that sort. We will see that. And total equity of 4.6 billion that keeps increasing. Okay, that's good. The net income we have on the top line before our examination of the operating activities free cash flow as usual. Some depreciation amortization going on here. And operating activities cash flow is positive, obviously very good. Investing activities cash flow, the company has been acquiring some companies, I'm assuming here. Investments in PPE, that's also good to see, of course. And what about here, the net cash used for financing activities? Slightly negative because the company has been paying back some debt. That's also a good thing to see. Also getting some debt as well, but a net payer of debt. That's good. Free cash flow is 1.29. Is exactly what we would expect based on the numbers that we examined earlier. And it has been increasing, and that's a good thing to see. Although again, I'm a little bit concerned because it has been increasing a lot in the last couple of years, and especially this last year. I don't know how sustainable that is. That's a thing that could be a little bit concerning. We could always be taking a look at the quarterly and see how the company is doing in quarters in terms of free cash flow to see what caused this increase. It looks like Q4 2021, Q3 2021, also Q2. So the whole year they have been doing pretty well in terms of their free cash flow here. Very interesting. What about the price to pay for this company though? What is a cool price to pay for this one potentially? Because I want to be getting these kinds of companies at a low price, as low as possible. I like to buy them when people are not excited about those. And regardless of that, I want to see what's the fair value right now. So revenue growth, we can use. They have had some negative years, so they had 6% here and then some massive increases. I probably need to go slightly low here, like 7, 9, and 11. That may be a little bit much even. Net income margins probably we can use 6, 7, and 9. Let's try that. Free cash flow margin, except from this year, it's typically, I guess, near 100 and 120. So I'm gonna go, let's go 90, 100, and 110. These are like typically good free cash flow margins. Annual return of 13% is what I typically want to be making out of pretty much every single stock purchase that I make. And if I hit calculate, I'm seeing that right now the current price is expensive for what it is, for what the company is in terms of what they're making. And some of these projections may even be a little bit overconfident actually. Because we don't really know if the company will keep sustaining this kind of insane revenue growth here. I don't think that's going to be the case, to tell you the truth. And so, yeah, this 11% could be a little bit much. I'm not sure. But 32 still is the high estimate that we're getting here, and the current price is 55. So we're still way off even for high estimates here. And this is why I would probably not invest in this company right now. Although it looks like it's a company that's interesting and it's doing well. The price is expensive and it's really not for me right now. I think there are better, cheaper ones really. And I hope you enjoyed the video. Please remember to leave a like and subscribe. Very, very soon I will give you access to this tool. Remember to stay around for when that happens, and the best way to do that is by subscribing and potentially hitting that button that actually shows you the notifications about channel updates. And thank you for watching this one. And if you did enjoy this video, please take a look at this other one that I made earlier. It discusses Netflix and talking a little bit about how the company is doing while waiting for the upcoming earnings report. Thank you for watching this. See you soon. Bye-bye.